A lot of times founders ask me what they can do at formation in order to protect themselves when they get to investment. I think in particular, folks are thinking about what founder stock is and what protections might exist in founder stock. When we talk about founder stock, what we generally mean is common stock that's issued to founder. There's no special legal meaning to founder stock aside from that. There are a couple of other types of stock that sometimes get issued to founders and gets referred to as founder stock. One of those would be Series FF, and the other one would be Class F. They might be called different names, but the same general definitions that follow are going to apply. For Series FF, this is a series of preferred stock that's essentially the same as common stock in all material regards, except that it's able to be converted from Series FF to some series of preferred stock that's sold in a financing. So for example, you get to Series A, the investors want to put $8 million into the company, and they're going to allow for some partial cash out for the founders. So the founders get, in aggregate $1 million to split amongst themselves, and the remaining $7 million would go into funding the company's operations. If the founders do this with common stock, then it creates a couple of issues. The first is that the investors really don't want to purchase common stock. So the founders selling common stock directly to the investors would be something that wouldn't be that appealing for the investors. The other issue is that if you sell common stock at a certain price per share, which in this case would be the same as the investment price, this can increase the tax value for purposes of future awards that you might issue to employees. And that's generally seen as something that's unfavorable because you lose some of the tax optimization for the folks that might get involved in the company later. The Series FF seems really helpful, but it's actually not implemented that much, and the likelihood of it ever coming into play is pretty minimal. First off, investors don't generally agree to partial liquidity for founders in the early stages of investment. And even in the instances where they do, there are some generally accepted methods of accomplishing this without having to do some sort of prior setup like Series FF. With regard to Class F stock, what this is generally it's a class of common stock that gives the founders some super voting rights. So there may be something like a 10-to-1 voting right for one founder for multiple founders, and this would allow them to maintain control over the stockholder vote even in the future if they don't have a majority ownership anymore. So this one is less about tax optimization and more about a substantive issue between founders and investors. In theory, this is great, right? What founder wouldn't want to be able to maintain control over the company as they're moving forward, be able to raise money, get diluted with their financial interests, but still be able to manage the direction of the company and protect themselves in all sorts of future actions and transactions. This would be great. That said, there's a sort of missing component to the equation here, which is what the investors are going to say when you get to investment. You're not just going to approach investors and say, well, we implemented this super voting right at the outset of the company, so I guess there's no one doing that. So the investors are going to say no. First off, it's not that hard to undo this. If you implemented it, we can unimplement it. At these investments, a lot of things change in the structure of the company. The capital structure is changing, the management rights are changing, the board composition changes. There are all sorts of changes that happen in the corporate charter and a whole lot of contractual rights that get afforded to investors. So it wouldn't be hard for there to be agreement to modify this to the preferences of the investors at that point, which is essentially what happens in an investment anyways. So you're not setting up some sort of impenetrable defense at the beginning by implementing these kinds of things. You're really just sort of pre-negotiating terms that may or may not be agreeable at the time of investment. A few prominent instances of the super voting right being implemented would be, Facebook and Zynga. There you have to imagine that the investors are looking at this opportunity to invest and say, well, look, there's a lot of competition here. This company is hot. It seems like these companies are headed towards an IPO. And even if we don't get the sort of conventional level of influence that an investor would typically get over a startup, we feel like there's a high likelihood here that we're going to be able to turn this into a financial return. So bottom line is, if you're hot enough where you can actually negotiate this right, then you'd be able to negotiate its implementation rather than its retention. In all other instances, you've implemented some complex capital structure that just isn't necessary. So this maybe begs the question, how do founders protect themselves? And the answer to this is just practically speaking, an individual founder is going to protect their own interests by remaining indispensable to the company. As a quote-unquote founder class, if they vote their stock in their mutual interests, then they're generally going to protect themselves just by being a voting bloc that's generally going to have enough voting power to protect their interests for a good period of the growth phase. At the end of the day, if you look at the role that investors have in startups, then it does sort of make sense. They want to have some sense that the founders in the company aren't just going to have unfettered protection where, if somebody stops delivering their value, or if there's friction between co-founders, or any other reason where a founder is either not delivering their value or actually becomes detrimental to the company, that person is dispensable. Investors generally wouldn't invest in a company unless they had faith in the founding team and the management of the company. But if that sort of scenario does arise, they want to know that somebody is not just going to have a guaranteed position in the company where they can't be reined in or dismissed if necessary. And this is just part of the trade-off. In a high growth company, you're burning through lots of cash, and that cash comes with a corresponding interest of the investors that are putting that cash into the company. You can bootstrap and scale at a slower pace and maintain more control over the company, but obviously both paths are going to have their pros and cons.